Raymond and speak, but first I'm just going to present a little bit on the current ongoing competition that we have going on. Um, let me just present really quickly. So we're currently in the midst of our Youth Sustainable Investment Challenge called YSIC, and it's an ESG themed portfolio management competition where you get $1 million in virtual cash, and you're gonna have around 2 months to construct a portfolio and do a bunch of like reports. Here's a look at the rounds that we have. So right now, even though we've already started, it's not too late to join because we're in the middle of our round one with our midterm report due on May 5th. And this includes a one-page impact proposal and a one-page trading strategy. And you also need to get 2 trades done by that time. And then we'll proceed with round two and round three. So if you want to take a picture of this, there's also going to be more information on our Discord. So why should you join YSIC? It's going to improve your financial skills. You're going to get hands-on trading experience, and you're also going to hear from experts like Raymond in webinars like this. And you'll also have the opportunity to win a bunch of prizes, including cash funding and also internship and recommendation opportunities. You'll also you'll also improve your communication and your time management skills when you communicate with your team. And basically, there's a lot of deadlines that you need to meet. And last but not least, of course, it will help your college application. If you place well in this competition, you can put it in the award section of your Common App. Here's a look at a brief overview of some of the prizes that you can win. These are cash prizes, first, second, and third, as well as the People's Choice Impact Award, which is voted on. And you can see that about half of your money will go to you personally, while the other chunk will go to funding for your impact project. And if you're interested in signing up, here are the 2 QR codes that you need to sign up for in the job form and the stock track. And also here's where you can get to know more about YEFA by DMing Allison on WeChat or joining the Discord. And I will send both of these pictures of both of these slides in the group chat if you need help signing up. And now I'll pass it off to Lynn, I think, to introduce the next topic.
One second. I think it's time for Ray to show up. Ray, are you here? Ray? Arab, can you keep sharing the slides? So
Yeah.
just 1 second. Just 1 more second. I think he's having some technical issue, but he'll be here in just 1 minute.
And let me know if you want me to return to any of the slides, anybody in the meeting. If you want to take a picture of it, I can also send a picture of any of these slides in the chat also.
Okay, Ray is here.
All right. Do you want me to stop sharing? Round breakdown slide. Yep, I can send a picture of that. Give me a sec.
Ray, do you want to start? We just finished introducing the competition. Let's give it a second.
All right, so you finished the intro?
Yep.
Yep.
How's it going so far? Hey, how have you been, Eric, by the way?
I've been good. It's been a while since we talked. I'm probably gonna come back this summer if you're there, so it'll
Yeah,
be good to see you.
likewise. Yeah, it'll be good to see you as well. Um, how's everything going with the trading competition?
Pretty good. We have a ton of signups, and we're just running the competition. Obviously, the markets are in a little bit of a tough situation right now, but yeah,
I
it'll be
can't
interesting to
imagine
see how it
why.
plays. Yeah.
Okay. All right. So I guess as we get more into the competition, I'll start to pay more attention to what everybody's doing individually and look at who's in the lead, who's not in the lead, what trades they've made, what has worked and what hasn't worked. But since we're just getting underway, I'm not going to do that today. So I guess what I'll do first is share some slides that I share. Anytime I do a program like this, I like to talk about the basics first. And often what happens um, when people start doing stock simulations or trading stocks for the first time or trying to analyze stocks, they don't really have a good sense of what is driving the markets and what's making things go up, what's making things go down. So it's always a good idea to start with the basics. And so we can do that for a little bit, and then we can talk a little bit more about current events and how that is shaping the market. Obviously, there's been a lot of news in the last few days in particular. Um, so there's a lot to talk about. There's a lot to talk about every week. This is a full-time job. Honestly, if you want to keep on top of the markets, you really have to do this full time. And to be honest with you, there are a lot of careers, great careers in doing finance and economics. So this is something that you can do professionally. This is something you can go to college for. This is a place where you can find a job and make a lot of money. But it is a full-time job. If you're just trading from home and you're just doing a simulation, it'll give you a little flavor of what's going on in the markets, but it's hard for you to keep track of all of the companies you're investing in. It's going to be hard for you to read all of their 10Qs and all of their 10Ks. That's their annual report. It's going to be hard for you to read all of their press releases and all of their earnings releases. It's just very time consuming. You're going to have to listen to all of their conference calls where they go through the earnings report and the CEO and the CFO explain to you what they did correctly and what they did incorrectly. Then you're going to have to build a spreadsheet and figure out what's going on with the numbers. Did they go up this year versus last year, or did they go down this year versus last year? Then you're going to have to build a comp sheet so you can compare this company with all of its competitors within the same sector and the same industry. That's a very time consuming process. So it really is a full-time job. Doing this part-time and just trying it out is great experience. And hopefully it'll give you a little bit of flavor for how the stock market works and how stock picking works, how portfolio management works. And it's something you might want to get into full-time at some point. It's very lucrative. You get paid a lot, but that's up to you. But I want to talk a little bit about some of the basics. So I think what I'm going to do is share my screen first. And I don't know, Lynn, did you make me a co-host or not?
I did. You're
You did, okay. Give me a second. Okay. All right, here we go. So let's talk about stock trading a little bit. A lot of times people have asked me over the years, why is this stock going up and why is this stock going down? And the joke answer, which is also the true answer, if the stock is going down, is that there are more sellers than there are buyers. And of course, everybody gets pissed off when you say that, but that's the reality of the situation. It's not entirely the situation, because a lot of times there are large sellers or large buyers. There are the institutions such as hedge funds and mutual funds, ETFs, what have you, that have larger positions that they have to move. But those trades get broken up into little teeny bits of 100 shares each. And so when you have an in-depth look at the market, you can see everybody's position and where they're marking, where they would agree to buy or sell that stock. And if there are more people on the sell side, there are more people offering the stock than there are people bidding on the stock. The bid-ask spread is going to get compressed, and the stock is going to move in different directions. So the reality is, the joke is true. There are more sellers than buyers, and on up days there are more buyers than there are sellers. So why do you buy a stock? Why do stocks go up and down? Other than buyers and sellers, why do people want to buy a stock, and why do stocks go up when people want to buy it? And conversely, why do stocks go down, and why do stocks, why do people want to sell a stock? And the answer is this. Unlike some assets, such as commodities like oil or wheat or gold, unlike some things like cryptocurrency, stocks have an intrinsic value, and that is that they have a ownership stake in a functioning operating company. And as an owner, you have a right to the profits in that company. And that's what it's all about. That is what makes stocks go up and down. So as an owner, a partial owner of a company, you're very interested in, is this product selling or is this product not selling? Are the profit margins going up or are the profit margins going down? Are we earning more money or are we earning less money? Do we have too much debt coming due in the future? Are we going to be able to repay that debt at some point? These are all questions you're going to have to ask as you get involved in stock trading. And I know that's a lot to get into, but on the very superficial level, it's about the earnings, because you get a share of the profits. And sometimes you literally get a share of the profits. There are a lot of companies that pay dividends, which is to say that when they make a profit, they give you a check for the money. They send you the money. There are a lot of companies that don't do that, but they reinvest the earnings into growth. And a lot of technology companies are like that, because they're growth companies. Their stock gets a higher valuation. And as long as they continue to grow, they'll continue to enjoy that valuation, and the stock will keep going up. So it doesn't really matter. I mean, it does. But if a company's doing the right things, I should say, it doesn't matter if the company's reinvesting in growth or if they're just giving you the profits. Either way, you're getting the money, and the stock should go higher, as long as the other criteria are met. The revenues are going up and the profits are going up. If profits are going down, nobody wants a company stock. Nobody wants to own a company. Let me put it that way in simpler terms. Nobody wants to own a company where the profits are going down, because they'll eventually go to zero or turn negative, and then the company will go bankrupt. And in that instance, the stock is worth nothing. It's worth zero. So that's a stock that, you could lose all of your money in. So profits are key. Now, that means that the quarterly earnings reports are key. Companies who trade in the United States are required to report their earnings every 3 months. They don't always report on a calendar schedule because some companies have a fiscal year instead of a calendar year. And that's particularly true for companies like retailers that sell a lot of goods during the holiday season, and they don't want to close their books on December 31st because they're in the middle of their holiday rush. They're selling a lot of stuff. And then come January, they get some returns and they get some, people get a different size of whatever shoe they bought. It doesn't matter. They're really too busy to close their books. So, I mean, that's not the point. The point is, though, that companies report on a different schedule. It's not all a calendar year. However, I will say this. Earnings season starts this week. So buckle your seatbelts because it's going to be another rocky week in the stock market. We've got a situation where it's been very quiet on the earnings front, but there's been a lot of other news that's external to the stock market that has been driving stocks up and down. Well, let's start with the basics. Stocks go up when they earn more money because you, as a partial owner of the company, earn more money. Here's an example of Google where the stock was trading along, is doing fine, and then they had their earnings report after the market and the stock popped. Now you'll notice that it opened higher than it closed the previous day. This didn't happen during the trading day. And I want to point that out because it's something that a lot of people have a misunderstanding about. A lot of people think you can day trade stocks and make a lot of money. But the reality is the stock doesn't usually move a whole lot during the day. It's overnight when the stock's not trading that the news comes out, and then the stock opens at a different place up here than when it traded during the day. You could have traded it all day in here if you're a day trader, but unless you're an investor and owned the stock the whole time, only then would you get the benefit of that higher open. So let's see if I have enough bandwidth on this. I'm going to play this clip. Oh, you know what? I have to go to share audio, don't I? Okay. So here's what happens when the stock reports after the close or before the open and then opens much higher.
Google, as you can see on the side of your screen, moving higher by 4%, a big beat for the quarter just passed for them, coming in with 75.3 billion in revenue. The forecast was 72.2 billion and an EPS of $30.69 per share. The forecast 27.34. If we just go down the individual line items, it is Google Search that has the biggest beat on that revenue line, 43.3 billion. The forecast was for 41 billion. Most of the other lines are very slight misses, offset by that big beat in search, but really in line. I mean, a very, very strong quarter overall. YouTube, 8.6 billion. Google Network members, 9.3 billion. That was a slight beat. Google Other, 8.1, and Google Cloud, 5.5 billion, in line with forecast there. But unsurprising to see a nice move higher in the shares at 4% because it's a comfortable beat, Sarah, on both lines.
Okay, so they beat earnings expectations.
Google, as you can see.
Oops. Okay. A key point is that the stock price is sometimes based upon the intellectual property of the company, the copyrights, the patents, the assets of the company, but most often it's based on the expectation of future earnings. And if those future earnings are going up, then the stock price will go up. And if the future, or even if the current earnings are going down and the expectation is that earnings will be lower in the future, the stock price will start to go down. So it's not what is really reported about past earnings that's important as much as it is about the future earnings. I always make it a point to tell people that if a company has a bad earnings report and you buy the stock afterward, that bad earnings report, whatever happened, Maybe they had a bad quarter. Maybe they had a bad year. That's not your problem. When you buy into the company, you're not buying the past earnings. You're not buying the past mistakes. You're not buying whatever happened in the past. You're buying what you expect to happen in the future. Their new model comes out, their new line comes out. The revenues are going to go higher, the profits are going to go higher, and therefore you're buying that stream of cash flow in the future. You're not buying the past, you're buying the future. Okay, so let's look at another example of how this works. Here we have a company called Meta Platforms, formerly known as Facebook. Ticker symbol is still FB. You've got a PE ratio of 17, which isn't that high for a tech company, but I think some people were expecting that the revenues or the earnings might go down. So obviously you can see by this chart exactly what happened. They reported their earnings and the stock went off a cliff. Again, when you listen to people talk about stock analysis and what the reports are saying, they always talk about the consensus estimate. That was when people were thinking about what might happen this quarter. What do we expect the stock to earn? And if the company does not meet those expectations, there will be disappointed investors that decide to change their mind and not be a holder of this stock anymore, and the stock will go down. If the company exceeds those expectations, those estimates, then there will be delighted investors that may want to buy more stock. Or there may have been people that were thinking, I'm not so sure about this company. Oh, now they report that they actually totally beat what all the analysts thought they were going to do. Now I want in, and they'll buy the stock. And therefore, there's a cascade of buying and the stock will go up. So in this case here, Meta Platforms had a bad quarter. Formerly known as Alphabet. No, this is Google. This is a different one. Oh, wait, what happened? I went back to Google again. There we go. There's Meta Platforms. All right.
It's a rare thing when someone you've been with for so long finds a way to surprise you. It's like discovering E-Trade's easy-to-use platform now comes with the power of Morgan Stanley.
Mom can speak walrus?
Yes, those Meta shares are plummeting on lower than expected first quarter guidance, as well as some evidence of user struggles for Facebook, the core app. Now, Facebook's daily active users declined overall, with a decline of 1 million in the U.S. and Canada between the third and fourth quarter. Now, the U.S. Canada is the most valuable region in terms of average revenue per user by far. Also, a decline of 3 million in the rest of world segment. The Europe and Asia Pacific divisions each adding just 1 million daily active users in the quarter. Now take a look at some of the other social stocks as well. Those stocks plummeting after hours on concerns about user engagement as well as slowing revenue growth. We see Snap shares down 19%, Pinterest off 10%. Both of those stocks report their earnings after the bell tomorrow. Twitter earnings comes next week, and those shares are down more than 10%. Guys?
All right. So as you can see, it's not just the earnings report, it's the expectation of future earnings.
Power E-Trade's easy.
All right, let me get off that. Yeah, we don't have to play a lot of videos about that. You get the general idea. So this can have a tremendous impact on a stock in any given day. Now, typically what happens, though, is a company will report earnings either after the market close, which is to say after 4 o'clock, or before the market open, which is to say before 9:30 on any given weekday. So if they were to report earnings in the middle of the day, it would just be craziness. Usually what happens is they'll report before the market opens. The stock will open at a completely different price than it closed at the previous day. And then over the course of the day, they will have their earnings call, and you can dial in as an investor. You can dial into the call, listen to the call, and ask questions. And the CEO will talk about the business strategy, and the CFO will talk about the revenue and the profits and why it went up or why it went down. And then they'll talk about their expectations for the future. And that's a key part of the call, because that's when you get a better idea of what they see happening in the future and how much money is going to be earned by the company going forward. Some companies give you an idea of, earnings might be in a range of X to Y, and some companies don't. Some companies say we expect earnings to grow in the low single digits, and then you have to kind of build a model on your own. But this is what really drives stocks up and down. It's a lot of expectations. It's a discounting mechanism. All right, so let's not play a bunch of these. Let's,
Of a disappointing
this
guide
is a good one.
for next.
This is a good one because this earnings report isn't so much about how much money the company made or how much they expect to make. This earnings report is driven by customer growth or lack thereof. And what happens is this particular company, which is Netflix, its share price is driven a lot by the expectation of future growth. If they add 1 million subscribers and then they can raise their price by $1 a month, it's a huge revenue increase, not just in volume, but in margin. If they have no new subscriber growth, it's a disaster because everyone is expecting a lot of subscriber growth. And that's what really drives a stock like
quarter
How
on
many
the
customers have they
global
acquired?
streaming paid net additions, which is where the miss comes in for the most part. It's 2.5 million, the guide for next quarter of paid net additions. The forecast people were expecting was for closer to 7 million, so a big miss on that. But let's just run through the quarter looking backwards. So a revenue for this past quarter, 7.7 billion, that was in line. EPS was a beat for this past quarter, 133. The forecast was for only 82 cents. And the paid net additions was a slight beat, 8.3 million. The expectation was for 8.2 million. When we get onto the forecast for next quarter, the revenue part of it is only slightly light, about 7.9 billion, whereas people were expecting 8.1. The EPS is a miss, 286. The forecast for next quarter, people were expecting 346. And the paid net additions for next quarter, as I mentioned, is where we have this big miss and why the shares are sliding. That is a forecast of 2.5 million paid net additions. The expectation from analysts was for 6.9. Let's bring in Julie.
I'm going to pause it right there because this is a really great example of why a lot of people don't understand the markets. Here's a case where Netflix met expectations for revenue. They beat expectations for profits. So one would think that if you met everybody's expectations, everybody would be happy and the stock would go up. However, they didn't meet expectations on new subscriber growth. And then when they gave their guidance for the future quarter, their guidance leaned towards, well, we might not grow our subscriber base that much, as maybe not as much as you're thinking. And that's a problem because then they're in a situation where everybody had bought this stock thinking that the revenues and the profits were going to go up exponentially forever. And then they don't. And that's a problem. So the people that bought the stock expecting future growth are now in a quandary. And they resolve that quandary very quickly by pushing the sell button and selling the stock. And then you have more sellers than buyers, and then the stock goes down. And you can see that happening in this stock chart. So you can always see that it happens after hours too. Over the long term, stocks go up. There's inflation, companies raise prices, profit margins widen, companies make more money, they pay higher dividends, stock prices will therefore go up. So there is an exponential nature, as you can see in the chart behind me, where stocks will tend to go higher, much more so than bonds or gold or the US dollar or any other investment for that matter. However, it's not smooth ride. It's a very bumpy ride. Companies have to report their earnings, and sometimes there are hits and sometimes there are misses. And it's your job as a stock investor to look into what your companies are doing and to figure out what is going right and what is going wrong, and choose your stocks that way. And it sometimes is a great idea to look at their competitors. In one of the video clips we just looked at, they were talking about the whole tech sector getting beat up because Facebook missed its earnings report. And sometimes you refer to that as painting the whole industry with a broad brush. Sometimes you refer to it as throwing the baby out with the bathwater. Sometimes you hear it referred to as the pin effect, which is a bowling reference where you hit the king pin in front and knocks all the other pins down. And that happens sometimes. Sometimes one company is screwing up and it drives the whole industry down, all their share prices, because it's natural for institutional investors to think, oh my God, if Facebook's revenue is going down, then I'm sure Google's revenue is going down as well. But that's not always the case. Sometimes you can find a stock that's been beaten up and is cheap or cheaper than it should be because of something another company did. And you see that all over the place, especially in recent weeks. Anyway, let's continue on. So yeah, here's a graphic on the Netflix earnings stream. It flattened out because their subscriber base flattened out and then the stock got crushed, but they recovered. I mean, let's face it, Netflix is the king of that whole industry. So they know what they're doing. They know how to get subscribers in. And then as soon as they do get the subscribers in, they raise the fee and their profits go up. And so does the stock. And so here we have a bunch of streaming services, and you can see what happens when bad things happen to one company. It tends to drag down the other. So this light blue line here, you can barely see it because it goes straight down and it's at the bottom of the chart down here. That's your Netflix. They had a bad earnings report, stock tanked, but it tended to suck these other ones down into a vortex as well. And some of these companies are pretty good and they didn't report bad earnings. They're doing okay. So why, I mean, that's not necessarily always the case, but But what I'm saying is that you can always find an opportunity somewhere. If somebody screws up and it drags the other stocks down, well, now these stocks are a lot cheaper down here than they were when they were up here. And it's not necessarily their fault. So you might find some good value there. That's why we do stock analysis. All right, now this is an old chart, but this is coming up again. Earnings season is starting next week. It usually starts with Alcoa and the big banks. Alcoa being the big aluminum company, and then the big banks like JP Morgan and Wells Fargo and whatnot. And then it gets really heavy. The reason for this is that the Securities and Exchange Commission requires companies to report their earnings within, I think it's 45 days after the end of the quarter. And for most companies, they are on a calendar quarter. So, we're only just into the month after the quarter end, which would be March. So, as we get into April, companies are going to start to report more furiously, and they'll all be done by May 15th, probably, unless they're on a fiscal calendar instead of a regular calendar. And as you can see here, it gets really busy. Look at all the companies that are reporting on any given day. It's just ridiculous. That's why I tell you, it's a full-time job doing this. There's no way any one individual can listen to all the conference calls for all of these companies. There's no way one individual can read all the 10Qs and listen and read all of the earnings press releases for all of these companies in this amount of time. I mean, this is a 1-week period. So a lot of times what you do is you have sector specialists, and a company will have analysts for individual sectors. They'll cover a variety of companies, but they will just listen to that conference call that day, ask questions on that call back the CFO, ask them questions, do their analysis, write a report. recommend to the portfolio manager whether they should buy or sell the stock. But covering the entire canvas of companies is almost impossible. It's really tricky. All right, so normally at this point in my presentation, this is where I would start to look at what you guys are doing on stock tracking. But I've been advised by Lynn to not do that. So I'm going to not do that today. We'll do that next time. Instead, what we're going to do is talk a little bit about current events and what's been going on in the market in recent days, because it's been very volatile. Okay. I got the second slide deck booted up, so give me 1 second. All right. So what have we been seeing? Something really awful. So if you've been trading stocks in your portfolio, as you know, almost everything is down. There are a lot of reasons for this, and there are a lot of things we can talk about with regard to why stocks have been down. Clearly, the recent tariff policy, well, let's start at the beginning. Certain large tech companies that are referred to colloquially as the Mag 7 or the Magnificent Seven have grown so large that they take up a disproportionate percentage of the stock market and the S&P 500. And I'm talking about NVIDIA, Microsoft, Apple, Google, Facebook, you know, the culprits. They're just really big companies. And a lot of these indexes are weighted to have the larger cap companies be a higher percentage of the index. So we've got a situation where those companies grew very rapidly and drove the market up. And their earnings expectations were lofty, and their valuations in terms of like their price to earnings ratio, for example, were just exorbitant. They're all bordering on ridiculous, particularly with NVIDIA, with everybody clamoring for new AI technology. NVIDIA's stock price just went through the roof. That slowed down. So that was a problem because they may not be doing as well as we expected. And that would drag down the whole market because they're such a large percentage of the market. Even though the 495 other stocks in the S&P 500 might be doing great, and you would think that because of that, the stock market would be up, because the large cap tech companies were not doing as well as expected, the market's been down. Then, then we got tariffs. So going back to what I said earlier, the market is a discounting mechanism, and it's discounting future cash flows. And you don't know for certain what those cash flows are. You have expectations. But when there's uncertainty around those expectations, it causes you to become very, very queasy, very nervous. And maybe you might want to sell that stock if you don't know if it's going to go up or down, because you don't know if the earnings are going to go up or down. And that's what we've seen this last week. The market does not like uncertainty. We want to have our estimates for how much the company's going to earn. And when the company meets that estimate, yay, the stock went up. If it beats that estimate, bravo, the stock went up more than I thought. I made more money than I thought. But if we don't have any certainty as to what the company's going to earn in the future, panic breaks out. And that's what we've seen over the last couple of weeks. This new tariff policy has been, well, bluntly, a disaster for the markets. There's no other way around it. Because not necessarily is it a disaster for the economy, but it has created a lot of uncertainty, and the markets don't like uncertainty. If you look at a company like, and their earnings are coming up on Monday, Levi Strauss. Levi Strauss is an all-American company, right? It's an American brand. They got started during the gold rush in California, making jeans for working miners who were digging for gold and trying to make a fortune and get rich. It's the American dream. And they eventually sold all of their denim mills to the Japanese several years ago. And they don't make any of their products domestically anymore. So they're screwed. They're totally screwed. So if these tariffs go through, Levi Strauss is going to be selling you an American product that's made somewhere else, and they're going to have to mark it up a lot. And they're probably going to, I don't know if they're going to lose money, but they're not going to make as much money as you assumed. So people's expectations for the stock are way off at this point, and they don't know what to expect now. And that's just taking one random company that's reporting earnings next week. So, you know, you multiply that by 500 and you've got your S&P 500 down 13, almost 14% year to date. And it's still early in the year. That's a big drop, and it's making people nervous. Now, beyond the fundamental things that I'm going to discuss with you, there are a lot of quantitative things in the background going on. The market doesn't like volatility. Quantitative funds, where the computers decide what to trade, they do not like volatility. When the markets become volatile, they sell, and they will sell everything. You're clearly seeing that going on. There are a lot of portfolio optimization strategies where computer will help you craft a portfolio that will generate the best returns with the least amount of volatility. So if you're familiar with portfolio management, you'll know this is the Sharpe ratio, where you try to get the best returns, but reduce your volatility. And it'll look at things like momentum. It will look at things like volatility. If your momentum slows and goes down, the computer will tell you to sell. If you get more volatility, the computer will tell you to sell. And you know what we have right now? We got both those things. Momentum's down. Stocks are going negative, and there's a lot of volatility. So it's not a good week to be in the market. But over the long term, the markets have always recovered from this sort of thing. Now, uncertainty, I think, will be resolved soon. And here's just one example that I'd like to play for you. Well, let's just listen to it first, and then we'll talk about it.
Here he is now.
Hi, I'm just trying to make sense of all this data.
Just get Saspaya.
Saspaya?
Skip one.
Hey, Sarah, we're just hearing from the president on a couple of different topics here, two big ones. The first I want to bring you is that the president is saying on True Social, he just had a very productive call with the General Secretary of the Communist Party of Vietnam on the tariff, saying that this man told him that Vietnam wants to cut their tariffs down to zero if they are able to make an agreement with the U.S. Trump says that he replied by thanking him on behalf of the U.S. and saying he looked forward to a meeting in the near future. So no definite moves happening there, but it does show that the president is taking calls. This is the first confirmation we have that the president has spoken to another world leader since these tariffs were put in place. This is while he's down in Florida. They say this call has been happening. And it also suggests, Sarah, that in a shift from what we were hearing from administration officials yesterday, this could be a negotiation for this administration. They could be open to deals now, despite what we were hearing at first. And remember, Vietnam got one of the highest tariff rates on Wednesday at 46%, also a country that's a big deal when it comes to transshipment out of China, trying to avoid the Chinese tariffs. A lot of companies have gone to Vietnam. So very interesting there if we could get a deal or see a deal with the Vietnamese. I also want to flag that just in the last 2 minutes, the president also posted on Truth Social about the Federal Reserve just ahead of Powell's speech. The president says this would be a perfect time for Fed Chairman Jerome Powell to cut interest rates. He is always late, but he could now change his image and quickly. He says energy prices are down, interest rates are down, inflation are down. So cut interest rates, Jerome, and stop playing politics. Obviously, it's not anything new, but given the context here, we know the Fed isn't meeting officially for a policy meeting until May, but it does come just ahead of that speech. We will see if the Fed chairman addresses it later today. Guys?
Yeah, so we've hit some turbulence, but I hope you haven't all barfed in your air sickness bags. I don't even know if they have those on planes anymore. Planes are much safer than they used to be. They used to give you a little bag to throw up in. The point I'm making by showing you this particular video is this, that a lot of this is carrot and the stick, and Trump is showing other countries the stick. And but he'll also give you the carrot. And this is not the only country that has already called the government of the United States. There have been several others. I heard a report today that Switzerland had had a conversation with Donald Trump. And no country is going to be want to be the last one. If Donald Trump talks to all these countries and say, hey, we'll lower our tariffs if you lower yours, then a lot of countries lower their tariffs. There's going to be a rush to the exits for these countries to get out of this. And nobody's going to want to be the last one that has a 50% tariff on US goods, and then the US has a 50% tariff on their goods, and there's no trade and they have no business. Because the US is the biggest consumer in the world. We buy everything. We buy the most oil. We produce the most oil. It's crazy how much we buy compared to all these other countries. And I think that Donald Trump and the government of the United States has learned a lot from China, because China has used this policy. They've often said, we're the biggest country in the world in terms of population, and we're going to have one of the largest consumer markets in the world. And if you want to do trade with us, if you want to sell your products in our country, you're going to have to show us some favoritism. The US hasn't done this, but they are now. They're like, hey, we buy more stuff than anybody else, so you're going to get kicked out and you're going to be the last one. We're going to let everybody else in if they cut a deal with us, and you're going to be out. So I think this whole thing is going to blow over soon. It's maybe not going to be tomorrow or next week or next month. It'll take some time, and there will be volatility in the markets. There's no question about that. But the reality is this will pass at some point. The US government is already talking to other countries about cutting deals and being friends. And a lot of this was brought on by other countries having higher tariffs on our goods and not buying stuff from us. And we had a trade deficit. So it's going to be addressed. And either way, we're probably going to see the trade deficit in the US go down. And we'll either onshore some more manufacturing jobs, or we'll sell more goods overseas because they cut their tariffs, we cut ours, and everybody's happy. I think it's going to work out either way. These things always do. The only thing you have to look out for is if this doesn't get resolved, in which case...
Hey, Sarah, we're just here.
Oops, sorry. In which case, if this doesn't get resolved, we could end up in a recession, and it could become a global recession, because this is going to impact other countries a lot more than it impacts us. It's going to impact us a lot. Prices are going to go up. People are not going to be happy. But because we're the largest consumer, other companies in other countries are not going to be selling nearly as many things to us as they thought they were, and those economies will all go into a recession. So nobody wants that, and it'll probably get resolved. If it doesn't, it's going to be an issue, but I think it'll get resolved. All right, moving on. Okay, so back to earnings. We were talking about how earnings can impact stocks. Let's look at what's going on this week, and then we're going to talk about some economic indicators coming up in the coming week. And yeah, we've got a few minutes left, so let's talk about this. So Levi Strauss, that I just mentioned, reporting on Monday. It's a big fashion apparel company still, and the last year's earnings were 26 cents per share for the quarter, and this year's earnings are 28 cents. That's the EPS forecast. So we've got some growth. There's still growth baked in. I'm willing to bet that they got on the conference call and they say there's a lot of uncertainty. Our cost of goods sold is going to be much higher. Our margins are going to shrink, and we're not going to make as much money as you thought we were for the rest of the year. And the stock will probably do one of these. So we'll see what happens. They're growing now. They were growing then. They're growing now. Probably not going to be going up that much after the earnings call. Also, we got Greenbrier companies. I don't know them. Dave and Buster's. I think probably you've been to one of those. They've got all the games. Ticker symbol play. They're reporting earnings not so good. Was $1.03 this quarter last year. Now 64 cents. Not a good day. All right, moving on. On Tuesday, we've got a bunch of stuff. You know, you might not be familiar with a lot of these companies. They're not really the big companies. So now they start to get bigger as we get towards the end of the week. We've got Delta Airlines, for example. I'm sure you've all flown on Delta Airlines. It's a fine airline. Earnings going down. That's not good. If the stock market continues down, there'll be less discretionary spending. And by that, I mean, people will not be feeling the wealth effect the way they used to. If people had some money in the bank and they had some money in the stock market and the stock market was going up, they felt like they were making money and they're wealthy, and then it's okay to spend that money in the bank because I've got money coming in from the stock market. But if the stock market goes down, then they feel like they're losing money, and then they don't want to spend the money in the bank. So we could hear something negative out of Delta Airlines. We'll see. I would like to point out that, again, we're going to have a situation where you've got to look at, if you're thinking about buying a company, you've got to think about all the other companies in that industry. And when I think about Delta Airlines, I think that they actually have a lot of corporate business class travelers. They're probably going to be okay compared to some of the others that have more leisure travels, like Spirit Airlines, JetBlue, Southwest, for example. There's no business class on Southwest. It's just, you know, random people going on vacation. Same thing for JetBlue. People from New York traveling around the country for vacation. Those airlines are going to have even more trouble because the wealth effect is going to be more impactful on them. One other company we can talk about is, and this is important, Constellation Brands, Constellation being stars, so ticker SDZ. Sort of an off-brand liquor company, but they branched out in recent years into beer, and they have all of the distribution rights for Mexican beer. It's particularly Corona in the United States. And this is going to be a big problem for them because the tariffs on Mexican imports are quite steep. So they're going to have a problem. Their forecast for the quarter ended March is $2.27 a share versus $2.26 in the prior year. Only a penny of growth. You know, that's, you know, less than 0.5%. That's nothing. And their earnings call, it's going to be important. They're probably going to say something like, well, our costs are going to go up because we got to get our beer from Mexico and it's going to cost us more in import duties. So, you know, it's really not that big of a deal for them. Beer is beer, and they're all the same price today. Back in the old days, if your moms and dads are listening, they'll know this. You'd go into a restaurant and they would have beer domestic at price X, beer imported, price Y. It was always a higher price. And if you wanted that beer, you got to pay an extra $1. So it's probably not that big of a deal. It's just going to go back to that. No biggie. All right, what do we got? Did I skip one? Oh, that's Wednesday. Okay. Thursday, we've got CarMax, Walgreens, drugstores. And then Friday is when the roof caves in because all the biggies are reporting. You've got some huge components of the Dow and the Wells. I almost said Wells Fargo because I'm looking at the ticker symbol. The Dow and the S&P 500. You've got JP Morgan Chase. You've got Wells Fargo. Progressive, the big insurance company. I'm sure if you've ever had a TV on in the room, a Progressive ad came on because they run ads constantly. BlackRock, huge financial services company. Bank of New York. And then Fastenal Company, which is like an industrial company. So, yeah, they got thrown in there too. Generally speaking, we've got negative earnings growth. Yeah, that's not good. That's not good either. going from $1.26 from last year to $1.23 today. That's definitely not good. Progressive, oh, they're doing okay. Let's see. Now, think about this. Are any of these companies impacted by tariffs? Probably not too much. So they are not producing anything over, and that is a risk, but otherwise these companies should be fine. Let's see what they say on the earnings call. Okay, just wanted to give you a recent example. Earlier we talked about how earnings impact the stock price. And oh, I've got a great clip to play for you about this. This is the company formerly known as Restoration Hardware. And they started as a chain of stores where they had like vintage hardware pieces for your home, like door handles and curtain rods. And then they sort of branched out and grew. Now it's like a luxury home goods store. And they rebranded to RH, and their ticker is RH. And they were doing fine. Everything's great. And, you know, home prices are up. Everybody knows there's a bubble in housing prices again. Homes are unaffordable. It's ridiculous. And then they had a sort of lackluster earnings report, but it coincided with the tariff announcement, and Restoration Hardware produces most of its goods overseas and imports them into the US. And then we got this, and then it continued on. Yeah, this is some sort of a bubble to indicate there's some sort of, you know, but it's also where the guy said, "Oh, beep," on the earnings call. It was quite hilarious because somebody leaned in while he was talking about the earnings and their expectations and said, "Our stock is down 25%." And he's like, "Oh," they actually beeped it out. It's pretty funny.
Listen, there's a good chance somebody's trying to hack your website right now. You gotta make sure you're covered.
And the earned.
Do we have that sound, Bill?
Yeah.
So Gary Friedman's on the call and apparently is notified in the middle of the call that his stock was down 25%. Yeah. Take a listen.
In this race, and I don't know where's our stock now? I mean, I guess you know the stock went down, you know, based on some of the numbers we reported, and then it got killed because of oh really? Oh shit. Okay. I just looked at the screen. I hadn't looked at it. You know, it got hit when I think the tariffs came out, and you know everybody can see in our 10K where we're sourcing from, so it's not a secret, and we're not trying to disguise it by putting everything in an Asia bucket. You know, so you can kind of figure it out and do the math. I think the people really that I feel worse for right now is all the manufacturers in China, or you know people who are invested there. You know, like that. You know, move manufacturing, move their lives.
Well, to your initial point.
Yeah. I mean, now he does talk about something that is kind of ironic, and anyone who's in the furniture business knows that the worst thing you could possibly have is inventory, too much inventory. But last night, he turned that into a positive. He said, listen, we happen to have a huge amount of inventory. Now, there are a lot of people who say, listen, he bought back a lot of stock with debt, so therefore he's, quote, in trouble. I don't know.
Right. Do I buy my Nike sneakers now because they're emptying out inventory before the price goes up?
No, you buy them at TJX. That's my point.
What about my
3 months from now, you buy
an
them at TJX.
iPhone right now before the price goes? Yes.
Well,
yes.
Yes, you do that. You buy an iPhone. Yes. And you buy a car. You buy a car because the price
buy a car now.
Yeah,
because
absolutely.
Q1 auto sales were like at a multi-year high. We're running almost 18 million annual.
March was the high until we see April. And April's going to be probably the biggest month.
And then we're just going to go.
And then May is going to be a huge month. And then in June, go buy yourself a car and you're a bozo.
Okay. That reminds me, their last comment. One of the reasons I put the thing up about Vietnam is because it is a huge supplier of apparel in this country, and it's particularly for companies like Nike. Nike is a huge company, and it's not just sneakers. It's not just, you know, uniforms, but they make all kinds of clothing, whether it's sports related or not. And it's a very, very large company. And a lot of their manufacturing is done in Vietnam. So that's a company you might want to keep your eye on, because depending on what happens with the tariffs, if the president of Vietnam's talking to the president of the United States and they resolve their issues and cut the tariffs back down, Nike stock is going to go right back to where it was. If they don't, Nike stock is going to go into the toilet. So that's something you need to pay attention to. The earnings are important, but the external macroeconomic environment is vastly more important over the long term.
Do we have a
And so speaking of the macroeconomics, let's see what's going on these days in terms of the economy internally.
Wix, one platform, any website, unlimited creation.
Like put a URL to a YouTube video, the ad would.
watching this open here? Obviously, S&P down, not quite 3%. Let's get to Rick Santelli this morning. Hey, Rick.
Hi, Carl. Indeed. Well, we had a March jobs report, and it was a solid report. But unfortunately, a solid report probably gets lost in the shuffle. A weaker report would have placed labor on a weaker footing. That would have had more of a lasting effect considering recent circumstances. Let's look at a week to date, the 2s and 10s together. As we sit right now, a 2-year is down about 34 basis points on the week. A 10-year is down about 31 basis points on the week. These are huge numbers. When was the last time we saw yields like this? Well, if you open the chart up for a 2-year, it's the 27th of September on a closing basis. For the 10-year, the 3rd of October on a closing basis. Now, there's some good news. The dollar index actually is moving higher today. Look at a 2-day, and do remember that the advertisement by the conventional wisdom brigade was that the dollar would soar when all of this occurred with tariffs. It was exactly the opposite effect. As a matter of fact, on the week, even with the bounce, we're down about 1.8% on the week. There were years when we were down 1.8% on the dollar index. And finally, when was the last time the dollar was here? Open the chart up. The last time the dollar closed at these levels was about the 3rd of October. What a coincidence. The same day that 10-year yields were down. So things are lining up. We see that many of the relationships between the dollar interest rates and differentials seem rather healthy. We want to pay very close attention to how the euro currency and the yen close, considering they're the two biggest contributors to the valuation of the dollar index. Sarah, back to you.
Oh, so overall,
Watching this open here, obviously S&P
doing pretty good. You know, we do have to pay attention to the macroeconomic indicators. You know, the economy drives the company's earnings, and the earnings drive the stock price in that order. So we have to pay attention to the economy, and we have to pay attention to the company's earnings, because that's what makes stocks go up or down. That's what changes people's minds on whether they'd rather be a buyer of the stock or a seller of the stock. So these are the things we have to pay attention to. Not a whole lot coming out this coming week. We've got some inflation news, Federal Open Market Committee meeting minutes. That's usually a snooze fest. Purchasing Managers Index, consumer sentiment preliminary on Friday. So we got a couple things. PPI producer price index. I mean, so we got a couple of inflation numbers, not a whole lot. This month is going to be, you know, a lot of earnings. So we're going to have to pay more attention to that. Now, I'm going to leave it there for now. We'll talk more about macroeconomics and how to build a portfolio bottom up or top down and how to think about things. But I'll leave you with this. As you're picking stocks, think about why the stock market is down in terms of uncertainty. It's largely because the tariffs are creating earnings uncertainty for certain companies. So then think about what kind of companies will not be subject to this uncertainty. And that's easy. Think about companies like your electric company, your gas company. Utilities, for example, they are getting natural gas domestically, no tariffs. They're charging you a higher rate based upon what the rate of inflation has been. No tariffs. They're making more money. They're paying a huge dividend. They make a profit and they just give it to you. They just give you the money. Utilities, very defensive sector of the economy. Healthcare, usually pretty defensive as well. Not as much. Consumer staples, that's a sector of the economy that includes things like foods and beverages, healthcare products like soaps and shampoos, razor blades. Now, some of those things are imported, but probably not many. We produce a lot of food in this country and a lot of beverages. So, those companies are the ones that have really benefited during the course of this last round of inflation for the past 5 years, where they've been able to extract more money out of consumers because consumers have no choice. You've got to have something to eat and you got to have something to drink. And none of that stuff is imported, really. Well, I mean, not always. You got Fiji water and stuff like that. Some of that stuff is imported. But the ones that produce it domestically are going to benefit. And those are the ones traded on the US stock exchanges. So think about that. If you're worried about uncertainty in the markets, if you're worried about volatility in the markets because of the tariff situation, think about finding companies that are not impacted at all by the tariffs. And that'll help you weather the storm. And when the market starts to see some more certainty, it'll turn around. And that'll be a good time to buy good companies at a good price. And I'll leave it at that. Back to you, Eric.
Thank you, Ray. That was really good. If anybody was not here for the beginning and you want me to reshare any of the competition details, we will be doing more of these. But if you want me to reshare the competition details, please let me know now. And if there's nothing else, I'll pass it back to Lynn.
I think it's better that you can, someone joined late, so it's better you can share it. Like reintroduce a bit about YSIC and where they can find us.
You want me to reshare the presentation?
Yeah, for like 1 minute. Just especially the most important thing is to let people join our Discord and also
Yep. Okay. Well, here, let me go back to the first slide. So here's a little bit about our competition. It's an ESG themed portfolio management competition where you get to manage $1 million in virtual cash. And we've already started our trading process. But you can still join because we haven't even gotten to our midterm when our midterm reports are due. So it's not too late to join. And here's a little overview of the rounds process. There's 3 rounds before the finalists are chosen. And I'll send a picture of this slide in the meeting chat so you can read it in depth. And why you should join this competition is you'll gain firsthand experience on financial skills and trading, as well as you'll learn a bunch through webinars like this with Ray. You'll gain prizes. You'll have an opportunity to win cash prizes and funding for your personal impact projects, as well as internship and recommendation opportunities. And most of all, it's also really good for your college applications. If you place well, you can place this in the awards section of your Common App. Here's a little overview of the prizes. As you can see, some of your prize goes to personal, like your own money, and some of it goes to funding for your impact project, which is part of the competition. And if you're at all interested to sign up, you can scan either of these QR codes, and I'll also send a picture of this slide in the meeting chat to sign up, as well as you can contact Allison on WeChat or join the student Discord where we're happy to answer any questions. Share the first page. Yeah, I can share I'll share a PDF of the entire slideshow, but if you want me to go back to the first page, do you mean this one? Okay, really quick, I'm just gonna export it as a PDF, and then you guys can uh take any part that you guys need.
Maybe you can just share the link to the deck.
Yeah, the link. Yeah, I can do that too. Um, so yeah, we're happy to answer any more questions that you guys have, and uh, if you guys want, if pictures work better, if a link works better, please let me know.
Yeah, just share the link to the deck.
Yeah, I will.
You got it?
I need to get the link first really quick. Just to view.
Yeah, it's just where you click the share button and then
Yeah, I did it in PowerPoint though, so I need to create a share link. Okay, I have the link. And there's a link if anybody wants it. Is there any other questions? Someone asked what the midterm report includes. I believe it includes something about what you're doing for your impact project as well as explaining your trading trading so far. I don't know if Lynn has any more to share on that.
well, the midterm report is just the one page of your impact proposal plus one page of your trading strategy.
Trading strategy, right?
And also you have to place at least two
trades. Yep.
And one of it should be ESG related stock.
Mm-hmm.
That's all for midterm requirements, and which is due by
I
May.
think we had May 5th, so a month from now. So if there's no more questions, I'll pass off to Lynn. Lynn, do you have anything else?
I think we're good. So we're all later constantly inviting professionals and in the investment industry to have this kind of similar webinars for our participants. And thank you everyone for joining us. Oh, I didn't turn on my video. And you can find the link to the deck in the chat box. Thank you, everyone.